Just yesterday, the CEO of Binance, one of the world's largest cryptocurrency exchanges, issued a statement that has captivated the attention of every crypto investor, analyst, and even traditional finance stalwart. The prediction: Bitcoin, despite its recent surge to unprecedented highs, breaching $119,000 and even touching $120,000 this very morning, is likely to experience dips before it reaches its next major milestone. Now, on the surface, this might sound like a simple, somewhat vague forecast in a notoriously volatile market. But when a figure like the Binance CEO speaks, the market listens. Why? Because Binance isn't just an exchange, it's a colossal ecosystem. It processes billions in daily trading volume, has a vast user base, and its native token BNB plays a pivotal role in the broader crypto space. Their insights are often based on immense internal data, liquidity flows, and a deep understanding of market sentiment. So what does this prediction of dips mean for the immediate future? We've seen Bitcoin on an incredible run, fueled by several significant tailwinds. Just to recap, the Trump administration's increasingly crypto-friendly stance, with President Trump even dubbing himself the crypto president, has significantly boosted confidence. The ongoing debates in the US House of Representatives this week, aiming to establish a clear regulatory framework for digital assets, are seen as a monumental step towards legitimizing the industry. The potential passage of the Genius Act for stablecoin regulation and even discussions around a US strategic Bitcoin reserve are creating an environment of optimism. Since their approval in January 2024, Bitcoin exchange traded funds, or ETFs, have become a massive gateway for institutional and retail investors. Inflows have been consistently strong, recently surpassing an astonishing $50 billion. This institutional adoption provides a level of legitimacy and accessibility that was previously unimaginable. Analysts, including those from Goldman Sachs, are increasingly predicting Federal Reserve rate cuts in the latter half of 2025. Historically, lower interest rate environments tend to drive investment into riskier assets, and Bitcoin often benefits from this search for yield. Furthermore, Bitcoin is increasingly viewed as a hedge against inflation, a concern that often arises in low interest rate scenarios. Given these bullish factors, why would the Binance CEO predict dips? It's crucial to understand that dips in the crypto market are not necessarily a sign of fundamental weakness. They are often healthy corrections within a broader uptrend, allowing the market to consolidate gains, shake out over-leveraged positions, and attract new buyers at more attractive price points. Let's delve deeper into what the Binance CEO might mean by next milestone and what strategic implications these predicted dips hold for investors both within and outside the crypto space. A milestone for Bitcoin typically refers to a significant price target, often a psychological barrier like $150,000 or $200,000, or a sustained period of stability at a higher valuation. The path to such milestones is rarely smooth, and indeed, Bitcoin's history is replete with dramatic surges followed by sharp corrections. We've seen this cycle repeat numerous times. In 2017 bull run and 2018 crypto winter, there was a parabolic rise to nearly $20,000, followed by an 80% drawdown. In 2020 to 2021 bull market, there was a climb from pandemic lows to over $60,000, followed by corrections. Now, recent performance, even with the current strong run, Bitcoin briefly dipped below $100,000 in late June before its latest surge. These historical patterns underscore the inherent volatility of Bitcoin, driven by a combination of factors including market sentiment, regulatory news, technological advancements, and macroeconomic conditions. The Binance CEO's prediction therefore aligns with this historical precedent, suggesting that periods of correction are part of the journey to higher highs. For investors, understanding this dynamic is paramount. It shifts the focus from simply buying the top to strategic accumulation during dips. This is where sophisticated investors and institutions often gain an edge. For retail investors, the prediction reinforces the value of dollar cost averaging, investing a fixed amount regularly regardless of price. This strategy smooths out entry points and reduces the risk associated with trying to time the market. Beyond just Bitcoin, the broader crypto market offers a plethora of altcoins, stablecoins, and DeFi tokens. Diversifying a crypto portfolio can help mitigate risk during Bitcoin dips. While Bitcoin often acts as the market leader, other assets might react differently or offer unique growth opportunities. Stablecoins pegged to fiat currencies provide a safe haven during volatile periods and offer liquidity. For traditional investors, understanding Bitcoin's potential dips means potentially using it as a hedge against inflation or as a diversifier in their broader portfolio, but always with an awareness of its high-risk profile. As its correlation with traditional market grows, investors might also consider traditional hedges against potential crypto-induced volatility in their equity holdings. Sophisticated investors often look beyond price charts. On-chain data such as exchange inflows, outflows, stablecoin supply, and mining difficulty can provide early signals of market sentiment shifts and potential turning points. Now, large inflows of Bitcoin to exchanges, for example, can indicate an intent to sell, potentially preceding a dip. The ongoing US regulatory push is a double-edged sword. While clarity is ultimately bullish, the legislative process itself can introduce short-term uncertainty and volatility, potentially leading to the very dips the CEO predicts. Investors need to stay abreast of specific bill proposals, amendments, and their potential implications. The Genius Act, for instance, while for stablecoins sets a precedent for broader crypto regulation, the ongoing discussion around the US strategic Bitcoin reserve also signals a deeper government involvement in the asset class, which could bring both stability and new forms of market manipulation. Now, the next milestone for Bitcoin isn't just a price point. It's likely tied to increased mainstream adoption, greater regulatory certainty globally, and perhaps even its integration into broader financial products beyond just ETFs. Think Bitcoin-backed bonds, derivatives, or even its use in cross-border payments on a larger scale. Each of these steps could be preceded by market adjustments as the implications are digested by investors. The CEO's statement could be interpreted as a cautionary note against irrational exuberance, urging investors to prepare for volatility as part of Bitcoin's natural price discovery process, especially after such a rapid ascent. It also signals the next path to the next milestone isn't a straight lineup. Now let's zoom out and analyze how these predicted Bitcoin dips and the broader cryptocurrency market movements could impact the US stock market and the global economy. The days of Bitcoin operating in a silo are long gone. Its increasing integration with traditional finance means its movements are no longer isolated. Firstly, let's consider the correlation between Bitcoin and US equities. While Bitcoin was once touted as an uncorrelated asset, research and institutions like ResearchGate shows that correlation levels with major US equity indices like the Nasdaq 100 and S&P 500 have intensified, particularly after key institutional milestones like the introduction of Bitcoin ETFs. This correlation can peak during risk-on periods where investor optimism drives both markets up, but it can also manifest during risk-off scenarios where a downturn in one can spill over into the other. A significant Bitcoin dip, especially if sharp or prolonged, could trigger a cascading effect in several ways. Now, we've already seen how companies with significant exposure to Bitcoin or the crypto industry, such as Coinbase Global, MicroStrategy, and even certain tech companies that have embraced blockchain see their stock prices directly influenced by Bitcoin's performance. Now, a dip in Bitcoin would almost certainly lead to a decline in these stocks. This isn't just about direct holdings, it's about investor sentiment towards the underlying technology and its future. If the flagship cryptocurrency takes a hit, confidence in the broader digital assets space can waver, affecting companies building within it. The crypto market, with its high volatility, acts as a barometer for speculative risk appetite. When Bitcoin experiences significant dips, it can instill a sense of fear and uncertainty across the broader financial markets. Now, investors might become more risk-averse, pulling capital from other speculative assets, including growth stocks in the tech sector, which often thrive on high-risk, high-reward narratives. This flight to safety could see funds move into more traditional, less volatile assets like US Treasury bonds or established blue-chip stocks. While still relatively nascent compared to traditional assets, the growing number of individuals holding Bitcoin means that significant fluctuations in its value can have a wealth effect. For those with substantial crypto holdings, a sharp dip could reduce their perceived wealth, potentially leading to a slight contraction in discretionary spending. While this effect might not be immediately impactful on a macro scale, it's a factor to consider as crypto adoption continues to expand. With the surge in Bitcoin ETF inflows, traditional institutional investors, pension funds, hedge funds, sovereign wealth funds now have direct exposure to Bitcoin. During a significant dip, these institutions might be forced to rebalance their portfolios, potentially selling off the other assets to cover losses or maintain risk parity, which could create downward pressure in other segments of the market. Furthermore, if these institutions face redemptions due to poor performance in their crypto allocations, it could create further selling pressure across various asset classes. While current US policy seems crypto-friendly, significant and sustained market volatility could attract renewed regulatory scrutiny. If dips are perceived as indicators of systemic risk or investor harm, it could lead to calls for stricter regulations, potentially impacting the growth trajectory of the entire digital asset industry and the companies operating within it. This could create a chilling effect on innovation and investment. Now, it's important to remember that these are potential impacts. The US market is vast and diverse, and while the crypto market's influence is growing, it typically doesn't dictate the entire direction of the S&P 500 or Dow Jones. However, its increasing integration means its movements are now a significant contributing factor to overall market sentiment and certain sector performances. The Binance CEO's statement, rather than being a bearish warning, could be seen as a pragmatic outlook on the natural evolution of a volatile asset. It's an acknowledgement that even in a powerful bull market, corrections are an inherent part of the journey. For viewers looking to navigate these digital horizons, it reinforces the need for a well-informed long-term perspective rather than succumbing to short-term emotional trading. And that concludes our deep dive into the Binance CEO's Bitcoin prediction. The message is clear. While the future remains bright for digital assets, the path forward will be marked by intermittent turbulence. Staying informed, understanding the underlying market dynamics, and adopting strategic investment approaches will be key to harnessing the power of this evolving financial landscape. Join us next time as we continue to explore the convergence of crypto, AI, and blockchain. Thank you.